I
So,
can.
okay, thank you very much. So, you're welcome back again. Um, Now we want to look at investment property. This is a shorter standard than IFRS 5. And majorly here, we'll look at first understand what an investment property is. Then we would look at the recognition and measurement of an investment property. So according to um, IS 40, if you look at this definition here, it says that investment property is a property that is land or building or part of a building or both. That's the first interesting thing about an investment property. It is it is majorly land or a building, either land or a building or the two, land and building. And this land and building, it is held to earn rentals or for capital appreciation. That is an investment property. Land and building held for rentals or capital appreciation. That is investment property. So you need to be able to distinguish the land and building here that is an investment property from the land and building that is a PPE. For land and building that is PPE, it has to be used for a land and building to be PPE. It must be used in the production or supply of goods or services or for administrative purposes. Then it becomes PPE. But by the time a land is just held for rental or a building is held for rental purposes alone, you just want to collect rent or for capital appreciation. That is, if you have a land, for example, now, you just have it there, you are not using it. You're not using it for anything, it's just there. So in your books, that kind of land, you cannot have it in your books as PPE. That kind of land, it will be an investment property because you are holding it majorly for capital appreciation. Because when you leave land there, the value will definitely appreciate. And that is the picture around investment property. It is majorly land or building or land alone or even land and building, either land or building or land and building. And you are holding it for rentals and for capital appreciation. Okay. Now, there are some other informations here. So that is now, so if you have a land and you lease it out to another party, so it is still an investment property. That's the major thing here. Okay, so now I'm going straight to this part known as partially owned property and ancillary services. What we are saying here is this: it is now possible that you would have a building, and that building is like, let's say, 9 floors, and your company is using, let's say, 2 floors out of those 9 floors, and the remaining is leased out to another party. So that is owned, a partially owned or a partial use property. So meaning you are using a portion for administrative purposes, that is for your office use, and you are using another portion for rental purposes. So the challenge becomes, this building now, is it going to be PPE or is it going to be investment property? Okay, just like that KPMG building, for example. Now let's assume the owner also occupies like 2 or 3 floors and he lets the remaining floors out. So in his own book, is he going to put that kind of building as investment property or as PPE? The standard says that if you can sell the portion that you are leasing out, if you can sell it separately, and the portion you are using for your office use or for administrative purposes, if you can sell that one too separately, then that means you can easily know what their value is individually. Then the standard says that portion you are using, put it in your books as PPE, and the portion you have let out or you're leasing, put those in your books as investment property. That's if you can get their selling prices, the portion you are using separately, right? That's how you're going to do it. However, if it is not possible to get, if you cannot sell it separately, if you cannot sell it, that's the main thing. If you cannot sell it separately, that is whether the portion you are using or the portion you are letting out, if it cannot be sold out separately, then the determining factor will be what is the significance of use. If the portion you are letting out is significant, then that means you are going to classify the whole building as investment property. That is, if the portion you are letting is significant, the whole building is going to be classified as investment property. But if the portion you are using within your company is the portion that is significant, that is the one for administrative purposes, the one you are using as your head office, if it is that portion that is significant, then that means you are going to take the whole building as PPE. Then the question becomes, how do you determine significance? In practice, it depends on management judgment. In your exam, they will tell you that the portion that is used for rental purposes is significant. Then, if you are told that, then you know that the entire building is going to be treated as such as investment property. If it's so, all I've mentioned here now is this: for partial use property, you need to determine whether you can sell each of those use separately. Can you sell them separately? If you can sell it separately, then the portion you are using will be PPE in your books. The portion you're letting out will be investment property in your books. But if you cannot sell them separately, then we need to then consider the significance of use. If the portion that you are using for admin is the portion that is significant, then the entire building will be seen as PPE. If the portion you are using for administrative purposes for letting out is the portion that is significant, then the entire building is going to be seen as um, investment property. So we will see that there are some companies like GT Bank, for example. Now they have a land on the street my office is. So that land is just there. The only thing they use it for is that their staff used to come and park there. It's just there. That land is just there, but they have designated it for parking. So I just want to see if you understand what I've mentioned. That kind of land in GT Bank book, are they going to put it as investment property or as PP? I need one of you to just answer this.
PP.
That's correct.
It's
Yeah.
as PP.
Yes, yes, yes. That's very correct because they are now using it for administrative purposes. Okay, that means you understand or you understood what I've said. So that's partial use. Another dynamics for investment property is that you see, since investment property is majorly land or building, right? So there's something we call ancillary services. What the standard called ancillary services. Ancillary services are services like it's just like service charge. What we pay service charge for buildings, like so if your company own a building, for example, now, and you let it out to some people, you rent it out. Ordinarily, since you have rented it out, it should be it should be investment property. But if it is now your company that is providing electricity, meaning that those guys will just pay your company money. You are the one that will provide them electricity. If you are the one that will provide them water, if you are the one that will provide them security. So what I'm saying in essence is this: if there's a building that the occupants are paying service charge for you, right? And you are providing all of these basic things, electricity, security, water, and all of that, it can't be investment property anymore. Then it becomes PP in your books. because at that point now, that means that business is now your core activity. That's what you do. Because for you to be able to do that, that means you will have an admin office in that building that will be attending to them, because there will be challenges, no water, no light, no this. So that means you will be on top of that building, because they are paying extra for service charge, for ancillary service. So if ancillary services or service charge services, the one you might understand, if it's significant, then it can't be investment property anymore. It becomes PPE. That's why if you own an hotel, though they are letting it out, but is your all you just need is just to take your briefcase and enter. Water, soap, towel, everything is there. Everything you just pay. So hotel cannot be an investment property. It's going to be PPE. Just similar to if so majorly if ancillary service is significant, then that building becomes PPE. And if it is not significant, then it continues to be um, an investment property. So and that's what this one is saying, and that's majorly around what investment property is talking about. That's the major thing. So what is just here is how do you recognize it? It is the same recognition criteria as PPE, meaning that it is probable that future economic benefit as associated with the investment will flow to the entity, and the cost must be you should be able to measure it reliably. And the initial measurement is at cost, right? Just like PP cost, purchase price, um, import duties, all of those things, and directly attributable cost that you used to build it or buy it, whatever. That will be the initial measurement. And the subsequent measurement for investment property. Now, this one is different because it's either you are using a fair value model or you are using a cost model. Okay, so you see, is only investment property that is a non-current asset that we measure at fair value, or a non-financial asset that we measure at fair value. All other non-financial assets are measured at either at cost model or revaluation model. But only investment property, right? That is a non-monetary asset or non-financial asset that we measure at fair value. So financial assets, as you know, under financial instruments, they are majorly measured at fair value. We have done that, right? But for investment property also, you measure it at the end of the year, either using a fair value model or using a cost model, right? So you choose any of the two. And the cost model hasn't changed. It's still cost minus accumulated depreciation minus accumulated impairment losses. That is cost model. And fair value model is just the fair value. It's just the fair value, right? So meaning if an entity chooses fair value model, you find out that they won't depreciate that investment property. It won't be depreciated. And I have some notes here which you can look up. So it's just explaining fair value and all of that. But the key thing I need you to note for fair value model is that you do not depreciate if a choice of subsequent measurement is the fair value model. Okay, so and finally is it's possible that an asset that you were holding before as an investment property, it can become PPE.
Subsequent measurements.
Okay, so now I was saying that it's actually possible for an investment property to become PPE. Then what is important is that when an investment property becomes PPE, then at what value are you going to put it in your books? Or if a PPE becomes an investment property, at what value are you now going to put it in your books? Will the value change or whatever? So it's straightforward. So if you have an asset in your books as an investment property and it was, let's say, 50,000, you now want to make it to become PPA, it's still going to be that same 50,000. All that is changing is just the name of that asset and vice versa. So if it is PP and it's becoming investment property, it's just the name that is changing, right? But there is one thing you need to note, right? So which I will show you in this question now. This question explains it very plainly. And if you look at this question, 4.1, it says that a business owns a building which it has been using as head office. Okay. In I said, in order to reduce costs, on 30th June 2019, it moved its head office function to one of its production centers and is now letting out its head office. Company policy is to use the fair value model for investment property. Okay, look at this first paragraph now. So the guy owns a building, right? And he uses it for head office. So in June 2019, he moved his head office out. So he's not using it for head office anymore. So he's now letting it out. So what that means is that it will have been PP in his books before. But now that he has moved out from there and start letting it out, so it becomes investment property, right? So in the next paragraph, it says the building had an original cost on January 2010 of 250,000 and was being depreciated over 50 years. And I said at December 2019, its fair value was judged to be 350,000. We are now asked, how would this appear in the financial statement as at December 2019? You see, all this is asking us, if you note, this asset as at 30th June 2019 is when it stopped being an investment property and it started being PPE. Sorry, it stopped being a PPE and it became an investment property from June 2019. So now they are now asking me that how will it appear in our financial statement as at December, knowing that this asset was acquired in 2010 for 250 and have been depreciating it. And at the end of that December, its fair value is now 350. You see, the main thing is this, right? So I know the fair value is 350, but let me start from the beginning, right? So the cost of the assets was is 250 up until June 2019 when it stopped being PPA. I would what's my depreciation till that date? From 2010 the acquired date till June 2019, that's 9.5 years. Okay. If I multiply that by the depreciation per annum, this 5,000, which is 250,000 divided by 50 years, that gives me the depreciation per annum. If I multiply that by 9.5, this gives me the accumulated depreciation till the date when it ceased to become PPE. So at the date it ceased to become PPE, the carrying amount of that asset was 202,500, right? So at the end of the year, the fair value of the asset is now 350,000. You see, it's not a problem. In our books, the investment property at the end of the year will simply be 350,000. That is not the problem. The problem is that now that we have gotten a fair value of 350, that means there is a surplus. We have to recognize a evaluation surplus in the sum of 147,500. Then the question becomes that evaluation surplus should go to OCI for in line with PP. But for investment property, when you are using a fair value model for investment property and you fair value it, maybe there's a change in fair value. That changing in fair value for fair value model ordinarily goes to P&L. In fact, that is the difference between using a fair value model for investment property and using a revaluation model for items like PP and intangible asset. Then the challenge you have in the exam is this. At the date where this asset stopped being PPE and it started being investment property. This revaluation surplus here, are we going to treat it as revaluation surplus in line with PPE that is going to OCI, or we're going to treat it as fair value surplus in line with IAS 40 that will go to P&L? The answer here is that it has to go to OCI, even though the assets are ceased to become PPE. But you see, whatever gain the asset has made up until that date it ceased to become a PPE should be attributed to that PPE and not fair value. So it is if in the next year now, subsequent periods, we now fair value the asset again when it is now investment property proper. So the revaluation going forward or the fair valuation going forward, that is that one. So that changes in fair value is the one that will now be going to POL. But the initial fair valuation as a result of that change in use from being PPE to investment property will still be treated, that revaluation surplus will still be treated in line with IAS 16 and will be taken to OCI. So subsequently, when you start fair valuing the asset going forward, then any fair value surplus we have now can now start going to POL. So this goes to show that, right, when there's a transfer, when a PP becomes investment property, the date or the year end of the date it became that change in use, whatever surplus you have, you will treat it as what it was before, because whatever surplus it has earned, it earned it in its capacity as what it was. So going forward now, when it is now PPE proper, sorry, when it's now investment property proper, so going forward, any fair value changes can start going to POL. Again, in a similar case or wise, if it was an investment property, you now transferred it or you changed the use, it became PPA. If at the date of that change in use or at the end, you determine a fair value, whatever fair value surplus we have, it will be treated in line with IAS 40 and will go to POL. Then subsequently, in its capacity as PPE going forward, whatever revaluation surplus you are now having can then start going to OCI, and you're going to treat it in line with IS 16. So this one is major, and you need to really take note of that main point of how you treat the surplus at the date of change in use. It will be what it was before. You treat it in line with the asset it was before at the date or at the year end of change in use. Okay, is that clear?
Yes, sir.
Okay, so
Yeah.
Yes,
okay,
it's clear.
so
Yes, I have a question.
okay, please ask.
Yeah, good morning, sir.
Yeah, good morning.
So what if this asset initially, when it was PPE, it has a revaluation deficit that was already recorded in the OCI. Now, when we reclassify this asset under favor that's under IS 40, are we going to, like, subsequent period, if probably the loss we have recorded on the asset, the valuation deficit we have recorded on the asset, that the valuation could not cover it, subsequent period, are we going to net off the loss before we then start transferring the surplus to POL?
Oh, that's a fantastic question. Okay, no, you won't, because it's a separate asset. Netting off, you can only net off, like I've told you before, for the same class of assets. In fact, for the same class of asset. Now, this one is not the same class of asset again, so net off will not come in. Did I answer your question?
Yeah, thank you, sir. You answered this, sir.
Okay. Okay. So no more questions. So the final thing here is disclosures.
Sorry, hello, sir. Sorry, sir.
Yes, sir.
Okay.
Okay, you said they won't net it off. So you mean they'll take the loss to the, let's say that's PPE before, and you change it to investment. So they'll take it the loss to the investment. So I want to get what as in, I don't think I understand that. No, you won't
Oh,
net it off, sir.
okay.
Sir.
So
Okay, sorry, sorry,
okay,
sir. Just to add to that question.
okay,
So if we are not netting it off, for how long can we carry the deficit? Because it just be sitting in the book. So
oh,
just a
okay,
build up on the question.
okay. Good questions. Do anybody want to add to that? Okay, so if it's a loss, that one is not a challenge because loss is just for that year. It will have gone to POL and it will end there, right? So where it becomes a challenge is if it is a surplus, like in this case now. That is the one you that goes to OCI, and that is the one that will eventually end up in equity, and that's the one you eventually continue to carry forward, right? So you say, for how long would you carry it forward? Well, you won't really carry it forward for that long. For You don't even have to carry it forward, really. So by the time this one goes to OCI for that year, that same year you can reclassify it from. In fact, you should take it from OCI. Sorry, OCI will end up in equity. So in the statement of changes in equity, you should just take it from that reserve, that evaluation reserve. Just take it to your retained earnings. Okay? You can just take it to your retained earnings immediately. Right?
Okay, okay.
All right. Okay. So finally here is disposals and disclosure. So disposal is if you sell the investment property, you just compare the sales proceeds with the carrying amount. Any gain or loss you have, take it to POL. And the disclosure requirement is just telling us information that we might not find in the statement, like the choice of the model, like the type of investment property, is it land or building, like how did you even determine the fair value, like did you use an independent valuer and all of that. So you will see the disclosures that we have here. And some other information. So I can hardly ask this investment property because it's just short. It's very straightforward. The only thing I've mentioned in investment property is I talked about what investment property is, which is just majorly land or building that is that you rent out or that you hold for capital appreciation. And I mentioned partial use, right? You need to know that. And I also mentioned ancillary services, and the measurement basis is just that you either use fair value model or cost model. And I mentioned transfer, right? So a question goes like this. This was a past question. They gave us like a trial balance. The investment property is there, the rental income is there. They now told us that at the end, they value the investment property to be 14 billion. So prepare a statement of, right? So in my statement of profit or loss, one, this rental income from the property will go to POL as income. And again, I have a loss now because my investment property was 15 million. Now they have fair valued it to 14 million. So I will also recognize the loss for like a fair value deficit of 1 million or 1 billion to my POL again. And in my statement of financial position, the investment property value becomes 14 billion. Okay, and that is it. So you won't really have to. There is no need for depreciation or amortization or what have you. It's just that straightforward. And that brings us to the end of investment property on IS 40.